You deposited your own money, money you saved for decades, and somehow that one transaction flagged your account, and the IRS sent a notice for $10,000. This isn't a scam story. It's happening to retirees across America right now. People who did everything right, followed every rule, and still got blindsided. Not because they cheated, but because they didn't know about a 1970 banking law that was never designed with retirees in mind. Most retirees assume their bank is on their side, and in many ways it is. But there's a layer to your banking relationship that nobody mentions when you open an account. Not the teller, not the branch manager, not the welcome packet with the free tote bag. Your bank is also a federal reporting agent. It has been since 1970. That's when Congress passed the Bank Secrecy Act, and it fundamentally changed the relationship between Americans and their financial institutions. Under this law, your bank is legally required to monitor your transactions and report suspicious activity directly to the Financial Crimes Enforcement Network, a division of the U.S. Treasury. They don't need your permission. They don't need to notify you. And they are actually prohibited in many cases from telling you that a report has been filed. Here's where it gets personal for retirees specifically. The most well-known trigger in this law is the $10,000 threshold. Any cash transaction at or above $10,000 automatically generates what's called a currency transaction report, filed quietly, without your knowledge, directly to federal authorities. Now pause on that number for a second. $10,000. For a retiree pulling from a savings account, handling a home repair, gifting money to a grandchild, or consolidating funds after closing an old account. That's not an unusual amount. That's a Tuesday. And yet most retirees have never heard of this rule. Here's the belief flip that stops most people cold. This report alone doesn't mean you're in trouble. Millions are filed every year. But it does mean you are now visible. And what happens next depends entirely on what your other transactions look like. Here's something that should make you set down your coffee for a moment. The IRS and FinCEN don't just flag large transactions, they flag patterns. And some of the most common financial patterns in retirement, the ones that feel completely normal, even responsible, are the exact same patterns that appear in money laundering investigations. Let that sit for a second. Think about how retirees typically manage money. You might receive a lump sum pension payout. You could be drawing down a CD that just matured. Maybe you sold a car or received an inheritance, or you're helping a child with a down payment. These are normal and legitimate life events, but to an automated federal monitoring system, they can look like something else entirely. Here are the specific transaction types that generate the most suspicious activity reports among retirees. And this list might surprise you. Multiple deposits just under $10,000. Say you withdraw $9,000 from one account, then $8,000 from another across the same week. Even if both accounts are yours, or even if you're consolidating for a home renovation, that pattern has a name in federal law, and it's called structuring. And it carries its own separate penalty on top of anything else. More on that in the next section because it's the trap that catches the most people. Large round number withdrawals, amounts like $5,000, $10,000, or $20,000, like especially in cash, are disproportionately flagged by bank algorithms. Oddly specific amounts feel less suspicious to automated systems than clean round numbers do. Sudden changes in account behavior. If your account has received roughly $3,000 a month for 6 years, Social Security plus a small pension, and then suddenly sees a $45,000 deposit, that deviation alone can trigger a manual review. Frequent cash transactions in retirement. Some retirees, particularly those who grew up in eras where cash was king, simply prefer cash. That preference in today's surveillance-heavy banking environment creates a paper trail of red flags. None of these behaviors are crimes, but they all share one dangerous quality. They look like crimes to systems that were built to catch criminals, not retirees managing their own hard-earned savings. Have you ever made any of these transactions without realizing they could be flagged? Drop your experience in the comments. You might be helping someone avoid a real headache. Gerald spent 31 years teaching high school economics in Columbus, Ohio. The irony of what happened to him is not lost on anyone who hears the story. In the spring of 2021, Gerald's roof failed after a bad winter. 2 contractors. Multiple quotes. He settled on a local company that preferred cash, not unusual in the trades, for a job that came out to just over $22,000. A days. Roughly 7,000, 8 days, roughly 7,000, 8,000, and $7,000 respectively. He wasn't trying to hide anything. He was just withdrawing what he needed when he needed it, the way he'd always handled large expenses. 8 weeks later, he received a letter, not from his bank, from the IRS. The letter informed Gerald that his recent banking activity had been flagged for review under the Bank Secrecy Act, and that his financial records for the previous 24 months were being examined. He wasn't immediately charged with anything, but he was now in the system. And navigating that system, even when you're completely innocent, costs time, money, and something harder to quantify: peace of mind. Gerald hired a tax attorney. That alone cost him $4,000. The process took 8 months. 8 months of document requests, response deadlines, and the low-grade anxiety of not knowing whether your retirement savings are about to be frozen. In the end, Gerald was cleared. No penalties, no charges. But here's the part of his story that matters most. And this is the belief flip most people miss completely. Gerald didn't lose because he was guilty. He lost because he was unprepared. He lost $4,000 in legal fees, and he lost 8 months of stress during what should have been the most relaxed years of his life. And he lost something subtler: his confidence in his own financial decisions. All of it was avoidable, not by doing anything differently with the roof, but by understanding in advance how to make a completely legal large cash withdrawal in a way that doesn't look suspicious to federal monitoring systems. That's exactly what we're going to cover. But first, I should, because there is an instinct. A should. Because there is an instinct, yet not a completely logical, reasonable human instinct that kicks in when people learn about the $10,000 reporting threshold. The instinct says, well, I'll just keep my withdrawals under $10,000, problem solved. That instinct will land you in far worse trouble than the original report ever would have. Here's why. Federal law has a specific crime built around exactly that behavior. It's called structuring, sometimes referred to as smurfing in law enforcement circles. And it is a felony under 31 U.S.C. section 5324. The law doesn't require that you were doing anything else wrong. It doesn't require that the money came from illegal activity. It doesn't even require that you knew structuring was illegal. The only thing prosecutors need to prove is that you deliberately broke up transactions to avoid the $10,000 reporting threshold. And the penalty? Up to 5 years in federal prison, asset forfeiture, and yes, financial penalties that can reach and exceed $10,000, often applied per transaction. Here's the math moment that makes this real. Say you make 4 withdrawals of $9,000 each over the course of a month. That's $36,000 total. Now, federal prosecutors don't see 4 innocent withdrawals. They potentially see 4 counts of structuring, each carrying its own penalty. The total exposure on a case like that, legal fees included, could consume the majority of what you withdrew in the first place. And the villain mechanism at work here is subtle but brutal. It's the law punishing the appearance of guilt, not guilt itself. You don't have to be a criminal. You just have to look like one to an algorithm that doesn't know your roof needed replacing. This has happened to retirees, small business owners, farmers, and restaurant operators across the country. People with clean records and legitimate money caught in a legal trap they didn't know existed. Here's the belief flip. The safe move you think protects you is actually the move that escalates federal scrutiny from a routine report to a potential criminal referral. Knowing this changes everything about how you handle large transactions going forward. If this video has already changed how you think about your banking, A-like helps more retirees find this information before they need it. Most Americans operate under a foundational assumption about their legal rights. You are innocent until proven guilty. The government must prove its case before it can take anything from you. That assumption is only partially true. And the part where it breaks down should concern every retiree with a savings account. It's called civil asset forfeiture, and it allows federal agencies, including the IRS, to seize money and property suspected of being connected to financial crimes before any charges are filed, before any court date is scheduled, and in many cases, before you've even been formally notified of an investigation. Under the Bank Secrecy Act and related statutes, if your account activity triggers a structuring investigation, the IRS Criminal Investigation Division has the authority to freeze or seize the funds in question while the investigation proceeds. The burden then shifts, partially, to you to prove the money is legitimate. Here's the micro-story that illustrates this perfectly. A 68-year-old retired nurse in Georgia had her entire checking account, $43,000, seized by the IRS after a series of cash deposits from her small side business were flagged for structuring. She was never charged with a crime. It took her 14 months and significant legal costs to recover her funds. By the time the government returned the money, it had cost her roughly $9,000 in attorney fees to retrieve $43,000 that was hers to begin with. The villain mechanism here is one of the most insidious in personal finance. A system designed to fight drug traffickers and money launderers that has no built-in filter for retirees managing legitimate lifetime savings. The good news, and there genuinely is good news, is that protecting yourself doesn't require a lawyer on retainer. On it requires knowing 5 specific moves before you ever walk into your bank. Everything up to this point has been the problem. This is where it turns. Because here's the truth that gets buried under all the fear. None of this is unavoidable. The retirees who get caught in these systems aren't unlucky. They're uninformed. And information in this case is genuinely protective. Here are the 5 moves that change your exposure entirely. Like move 1. Have the conversation at your bank before the transaction happens. Walk in, speak to a branch manager, not a teller, and explain what you're planning. Say, I need to withdraw $20,000 for a home repair. What documentation should I bring, and is there anything I should know about how this will be reported? That conversation creates a record of intent. It's free. It takes 15 minutes. And it fundamentally changes how any subsequent review of that transaction looks to investigators. Move 2. Keep a paper trail that tells the story. Contractor estimates, invoices, real estate closing documents, gift letters. Whatever the reason for the large transaction, document it before the money moves, not after. A dated paper trail is your single strongest protection. Move 3. Never structure. Never. Even if it feels logical. Even if someone suggests it. Now that you understand the legal definition, you understand why this is non-negotiable. Move 4. Request a currency transaction report acknowledgement. You can ask your bank to note in your file that you are aware a CTR is being filed. This signals cooperation, not concealment. Move 5. Consult a CPA or tax attorney for any transaction above $15,000. Not after a letter arrives, needing it before the money moves. An hour of professional advice costs far less than 8 months of audit stress. If you only remember one thing from this entire video, remember move 1. A 15-minute conversation with your branch manager before a large transaction has protected more retirees than any other single action on this list. Here's the context that ties everything together. And it's the part most finance channels won't touch because it requires saying something uncomfortable out loud. The IRS audit rate for average Americans dropped steadily for most of the last decade. Budget cuts, staffing shortages, and shifting enforcement priorities meant that most middle-income filers went largely unexamined. But that trend is reversing, and retirees are sitting in a particularly exposed position as it does. Here's why. Retirees move money differently than working-age adults. Pension payouts, IRA distributions, inherited accounts, proceeds from downsizing a family home. These are all large, irregular, non-salary transactions, exactly the profile that automated flagging systems were built to scrutinize. A 35-year-old receiving direct deposit every 2 weeks barely registers. A 70-year-old making 4 large withdrawals in a quarter looks to an algorithm like a case worth examining. And add to that the current political pressure on the IRS to demonstrate enforcement activity, and the math becomes concerning for retirees specifically. The belief flip here is the most important one in this entire video. You are not being targeted because you did something wrong. You are being flagged because your legitimate financial behavior pattern, one you earned over a lifetime of disciplined saving, resembles on paper the behavior of someone who didn't. That's not fair. But fairness is not the standard the Bank Secrecy Act was written to deliver. The standard it was written to deliver is detection, and detection doesn't discriminate between a retired teacher in Columbus and a money launderer in Miami. It just looks at the numbers, which means the only person looking out for Gerald, and for you, is you. You spent decades building what you have. You showed up, you saved, you made sacrifices that people half your age wouldn't consider, and now, like in the years when that discipline is supposed to pay off, the last thing you should be doing is accidentally handing any of it to a system that never learned your name. The Bank Secrecy Act isn't going away. Civil asset forfeiture isn't going away. But exposure to both of them is almost entirely a function of preparation. Talk to your branch manager. Document your transactions. Never structure. And if a letter ever does arrive, don't panic, don't ignore it, and don't respond without professional guidance. Gerald got through it. So can you. But the version of this story where you never received that letter in the first place, that's the version worth working toward. And that version starts with knowing what you now know. If someone you love is retired or approaching retirement, share this with them before they need it. That's the most practical thing this video can do.